Asset location has a direct impact on your portfolio returns. So in today's video, I want to focus on what is the right way to position the funds that you're investing in into the right accounts, whether that's 401k or IRAs, that could be traditional or Roth, and brokerage taxable accounts for maximum tax efficiency. And I want to stress here that we're not talking about not paying taxes and breaking the law. Rather, we're talking about optimizing your portfolio for tax efficiency. All the rich people do this, all the financially savvy people deploy those tactics when they optimize their portfolios. So I thought for you also, as a beginner investor or a more savvy investor, you need to be looking and deploying those tactics for your personal portfolios. That being said, what I'm going to cover today is what is asset location and how to properly place our funds in different accounts. But I'm also going to give you a detailed walkthrough of, if we take a simple 3-fund portfolio, how to position those 3 funds into our different accounts. Now, by the end of the video, we're going to cover quite a few rules and guidelines, which I'm going to summarize at the end in one single table, so you have this as a reference when you re-examine your portfolio for tax efficiency. That being said, let's dive right into it. Welcome to another episode of Investing with Kurt, the channel where we focus on real investing advice rather than trading and speculation. In previous videos, we covered how to create an IPS or an investment policy statement, how to properly do asset allocation based not only on age formulas and rules of thumb, but also based on your risk tolerance. So another aspect which I believe is equally as important is building a portfolio by paying attention to asset location. Now, you may be asking, what is asset location? Is it similar to asset allocation? Asset location is simply the methodology that you use to position the funds that you're investing in into either taxable accounts or tax advantage accounts. Tax advantage accounts are either tax deferred accounts, those are your 401ks, 403bs, traditional IRAs, and there's also tax-free accounts, which are the Roth IRAs. So either of those accounts allow you to grow your wealth either by deferring or eliminating taxes as much as possible. And that's a great option, especially if you're starting out. You should be maxing out your 401k. Now, I'm using the Bogleheads wiki, which I believe is excellent. It gives you a lot of detail on the different asset classes, on the advantages of taxable and non-taxable accounts. And here's the thing, I'm just going to skip through some of the greater details here and some of the tables because they've got also a lot of numbers. If you want to study those numbers, I'm going to have a link in the description of this article so you can look at it in your free time. But I'm just going to skip to the real important part here. So if we've got taxable and tax advantage accounts, how do we actually position the funds in our portfolio in the smartest way possible? So starting from very tax efficient to very tax inefficient, going down this list, you will see that in the group of tax efficient assets, and let me zoom in here a little bit. In the group of tax efficient assets, we look at things like low yield money market, cash reserves, short-term bond funds, tax managed stock funds, large cap, total stock market. S&P 500 is a great example of a broad stock index fund, which is a large cap and is very tax efficient. Balanced index funds, small cap and mid cap index funds, value index funds. So if you notice, generally, every time we see index funds in the title here of the asset class, they all belong to these efficient asset classes. So if you're investing in an index fund and things like broad-based ETFs, which are very low cost, chances are they're very tax efficient, so they're safe to put in taxable accounts. Now, there are some funds which are sort of middle ground, which are labeled as moderately inefficient, and those are your moderate yield money market funds, bond funds in general, total market bond funds, active stock funds, or actively managed funds. So those are considered moderately inefficient. And there's the other end of the spectrum where you have very inefficient funds, and those are your real estate investment trusts or REITs. Also, funds which have very high turnover. For example, actively managed funds and funds which are frequently traded, they have what's called a very high turnover because a lot of people are buying and selling all the time. they're not long-term investors, and this generates many tax events, and this is why these funds are tax inefficient. Also, speaking of bonds, high-yield corporate bonds are also very inefficient. Alright, now that we know that different asset classes have different tax efficiency, let's take a look at how we can position those different asset classes into the different accounts that we've got. And for the sake of illustration and making this example a little bit simpler so you can understand how proper tax efficiency should be used into the different accounts, I'm going to do a couple of things. I'm going to assume that you have 3 different types of accounts: a taxable account, say an M1 Finance, Robinhood, or a traditional brokerage account. You have a tax-free account, say an IRA, and you have a tax-deferred account such as your 401k from your employer. And the second thing is I want to use a simple 3-fund portfolio which will be comprised of 3 index funds, and we're going to take a look at how we can position those 3 index funds into the proper accounts. Alright, so step number 1 is to really understand what is the tax efficiency of the 3 funds that we want to hold as part of our portfolio. And you can already see here in the diagram, it's already really nicely illustrated that the total US stock market or the S&P 500, any of those broad-based market index funds, those are generally very tax efficient. So they're part of this upper part of the tax efficiency spectrum. The total international stock market is also tax efficient, maybe not as tax efficient as the total US stock market, but there is a couple of other caveats there that are specific to the total international market. And the total bond fund, it's categorized as moderately inefficient because it's a mixture of different kinds of bonds. It's very broad-based index, so while not as efficient as the total US stock market, it's also not as bad as high-yield corporate bonds or REITs. So once we've understood what is the tax efficiency of our funds, then let's take a look at the first real step, which is placing the least tax efficient funds first. And the least tax efficient funds out of the 3 from our portfolio is the total bond market, or BND ETF. And the total bond market, as we said, it's moderately inefficient, so we want to put this either in our tax deferred or in a tax-free account. Now step number 2 is tackling your international stock fund, or the VXUS ETF that I have as an example here. You want to put the international stock fund, it being very efficient, into your taxable account. Another reason why you also want to put the international stock fund into a taxable account is because you also, when you do your taxes, you can also claim foreign tax credit from your taxable account. Now, we're not going to dive much into this, but just be aware that you can do some additional things with your international funds. And step number 3 is actually placing your most efficient fund into your taxable account. So your most efficient fund in this case is going to be the total US stock market. And what you want to do is you want to put the total US stock market, or the VTI fund, into your taxable account because it's not going to generate a lot of tax events. Obviously, you can put all the total US stock market and total international market into your tax deferred account. Just be aware that as you're maxing out your 401k, you may also want to keep a taxable account as well in parallel, because at certain point in time when you need the money, maybe in 5, 10 or 15 years from now, it's much easier to actually go into a taxable account and sell some of the shares which are performing well if you need the cash, while if you have all of your money invested in your tax deferred account such as a 401k, you can't really do that. You have great penalties, a lot of taxes, so it kind of defeats the purpose of a tax advantage account. Alright, so we looked at the example of this simple 3-fund portfolio and where each one of those 3 funds go into our corresponding accounts based on tax efficiency. What if you have a little bit of a different situation, or you're investing in different types of asset classes? Maybe you're experimenting with mid caps, large caps, small cap value, REITs, what have you. So I've outlined in this table here everything that should go into taxable and everything that actually is better suited to go into tax advantage accounts. So let's take a look at those real quick, and you can use this as a reference for your portfolio. So taxable accounts are really good for individual stocks or stocks that you plan to hold for more than a year, because holding a particular stock for more than a year, this means you're not going to be paying short-term capital gains. Rather, if you have to sell that stock, you're going to be paying long-term capital gains, which are slightly less than if you were to sell the stock less than a year. Also, taxable accounts are perfect for tax-managed stock funds. Those are your index funds or passively managed funds. ETFs also a great example of funds which are excellent because they're very tax efficient to go into taxable accounts. Also, stocks or mutual funds that pay qualified dividends are also good candidates for taxable accounts. And lastly, municipal bonds and I-bonds, they also belong to this special type of bonds which can be put into a taxable account. Now on the flip side, what goes into tax advantage accounts? Tax advantage accounts, they're great for funds which are, as we said, tax inefficient. And in this case, you can also look at buying individual stocks which you plan to hold for less than a year, meaning you're going to be incurring short-term capital gains. You can put those into your tax advantage account because that's going to shelter those stocks from basically triggering major tax events for you. Also, actively managed funds are also better suited in tax advantage accounts. They're very tax inefficient. They're usually associated with huge turnover rate. A lot of fund managers, they end up buying and selling a lot for those mutual funds to try to beat the market, and you want to basically put those into tax shielded accounts. Now also, what's really well suited for tax advantage accounts is the various types of bonds. So taxable bonds, zero coupon bonds, inflation protected bonds, high yield bonds, all those different kinds of bonds are perfect for tax advantage accounts. And lastly, real estate investment funds or REITs should also go into a tax advantage account. Now, having this table, I believe you can use it as a map or a guideline to really look at and examine your funds that you're investing in and properly position them into taxable and tax advantage accounts. Now, if you're just starting out, you may not have these various types of accounts, or you don't have enough funds to spread through all those different accounts, in which case simply investing in your 401k is good enough and you're pretty much done. But if you've been investing for a while and you have a little bit of cash accumulated and a little bit of investments already maxing out certain accounts, then you need to be leveraging these strategies to minimize tax. Alright guys, I hope this made sense and you learned something new today on investing. If you did and if you enjoyed the video, make sure to hit the like button, destroy the like button, and if I missed anything, put it down in the comment section. I'll make sure to cover this in the next episode. By the way, if you're new here and you haven't subscribed yet, make sure to also subscribe and hit the bell notification icon so I can notify you every time I post new videos on investing, because in this channel, we focus on real investing advice rather than trading and speculation. That being said, this is all for me today. I hope you have a wonderful day. I hope you stay the course, keep investing, and pay attention to your taxes.